John Brady, Senior Vice President for Global Interest Rate Products at MF Global. Typically, he joins us from Chicago, but as you can see, he's here with us in the studio today.
Thank you for having me.
So as you know, we've just talked to a couple of former Fed officials who are now professors about what they think Ben Bernanke should say. Obviously, you come to it with a different perspective. What do you think he should say today?
Well, we first of all and foremost think that Dr. Bernanke is going to be very bond-friendly today in his comments. There's little reason for the Fed chairman to sound hawkish at all as it regards interest rate policy. The key for Dr. Bernanke today will be to attempt to convince the markets that the Fed is aware of the slowdown currently taking place. However, they do not believe that the economy will dip into a double-dip recession or that deflationary pressures will intensify. We think it's going to be a bit of a tightrope act by the Fed chairman, and thus we do think that he will be very clear in the fact that long-term interest rates will probably head lower. He'll use the bully pulpit of the Fed chairmanship to perhaps drive rates a little bit lower on the long end of the curve because the balance of risks are clearly there.
Well, this is something I've been wondering about for some time. When you keep having rates that are already so low, and it's not enough to get people, buying homes, taking out loans. The loan demand in many cases is not there.
Right.
I mean, is rates going lower, even lower, going to make that much of a difference?
Well, it certainly is not going to on the front end of the curve. So we do not expect the Fed chairman to dramatically alter current funds policy in that range between 0 and 25 basis points. You have to keep in mind, Julie, that real interest rates can actually move higher in this low interest rate environment, specifically as CPI and core inflation continue to trend lower. And they most likely will trend lower in the course of the next year and a half. If you keep rate policy on the back end of the curve steady and core inflation drops, you're actually seeing a real tightening of rates. And thus we think that Fed officials want to stay ahead of that and perhaps drive the long end rates lower with the idea of keeping that spread at least stable.
John, let's talk about how the markets have been reacting to earnings that have been coming out over the past several days. What are you hearing from your folks, and what sectors are you impressed with?
Well, the sectors we're most impressed with probably are technology and utilities. The concern seems to be continuing in the financial sector. Specifically, we touched earlier about loan growth, demands for loans, the supply for loans, and the reticence by banks to make loans. Fact of the matter is, the fundamentals of the economy still seem a little disturbing.
Where's that hesitancy coming from? Is it that these rules are so stringent that banks don't want to get caught out there and have to go through this again, where they're making loans to people who can't possibly afford to pay them back?
Well, Mark, I think one of the unfortunate things is that nobody really knows. This is a 2,300-page piece of legislation, and much of which, the details of which, have been passed along to the regulators. Notice this morning, for example, the SEC is going to hire 800 additional people. They may be one of the few employers currently actively hiring folks. But the fact of the matter is, I think a lot of this legislation has been put down, has been passed down to the regulators, and thus it's going to take time for regulators and for banks to figure it out. The only sure thing within this bill is that the cost of being a bank from a regulatory standpoint is going to go up. So this whole idea of return on equity and valuation of banks is probably going to come into question, and the balance of risks over the next 3 to 6 months, not just from a macro standpoint, but from a regulatory standpoint, are probably to the downside.
John, unfortunately, we're out of time. Thanks a lot for coming in, though. It's good to see you in person. Appreciate it.
You bet.
John Brady of MF Global.